On July 17, 2026, a digital sales platform opened for the final developer release of the Rockefeller in Cape Town. What followed was a rush of capital so fast it defied the gravity of real estate. This chart illustrates the sheer velocity of the event. Within the first 15 minutes, buyers reserved 50 apartments. By the 6-hour mark, 59 of the 60 available units were claimed. When the dust settled on that single day, the transaction had injected 152 million rand into a single building. Commercial property deals usually take months of sluggish negotiations. They involve mountains of paperwork, lengthy due diligence periods, and cautious back and forth between legal teams. And right now, the broader economic climate is tense. High interest rates and shifting market conditions mean traditional office and retail spaces are sitting untouched on the market for extended periods. Yet, institutional and private investors completely abandoned that caution here. They initiated an absolute feeding frenzy for this specific building, moving millions at the speed of a stock trade. This visual breaks down the core difference in how investors calculated risk. On the left, the speculative model requires buyers to purchase a promise, putting capital into a blueprint, hoping demand materializes years later. On the right, the operational asset, the Rockefeller offered the exact opposite, a fully realized mixed-use hotel and residential complex, actively operating and hosting guests since 2021. Buyers on this platform weren't hoping for future returns. They were buying into an established hospitality asset with a proven track record. Moving capital into this building was an explicit strategy to secure de-risked, immediate yield against a backdrop of wider economic instability. Location heavily compounded that yield. The Rockefeller sits squarely in Cape Town's foreshore precinct. As South Africa's strongest performing urban tourism destination, the city possesses the infrastructure and global draw to keep accommodation assets consistently occupied. We can see how this location drives revenue by looking at its demand profile. The foreshore captures high volumes of international leisure tourists and perfectly pairs that with year-round corporate travel. Serving both markets simultaneously creates a buffer. If seasonal tourism dips, corporate bookings keep revenue stable, shielding the asset from isolated sector downturns. Once you have a resilient, high-performing asset, you need a way to distribute it. This is where the digital sales platform stepped in. The digital marketplace shortens the gap between interest and commitment by pre-verifying buyer documentation and automating the reservation deposit process. This bypasses the days of manual administrative back and forth that typically stalls commercial transactions. Put a highly profitable, resilient building on a frictionless digital platform, and a standard property launch turns into a highly competitive land grab. This 6-hour sellout serves as a leading indicator for the broader South African commercial property market. Serious investors are increasingly looking past traditional standalone residential buy-to-let models. The management overhead and vacancy risks are simply too high. Instead, capital is flowing into integrated, mixed-use environments. A single building that houses residential apartments, hotel services, and commercial operations simultaneously is the new premium standard. 152 million REs in 6 hours demonstrates that significant ready liquidity exists for this specific asset class. For developers, this success provides a strong, data-backed incentive to scale up additional urban regeneration projects across the foreshore. The Rockefeller success links the security of property investment directly to its operational performance within the tourism economy. A building is now valued as much for its integrated hospitality ecosystem as it is for its physical structure.